episode 111, a $3 million windfall. This is 39.6 Facebook and YouTube live finance show. The show that teaches high earners like yourselves how to make your money work for you, so you don't have to work for your money. Talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, even the car you drive. Today, we take a question from another Facebook group, an anonymous post, about a 39-year-old orthopedic surgeon who loves his job and recently hit it big with a startup investment. He invested $100,000 and is getting a payout of just over $3 million. All right. So in this question, he says, or she says, obviously this $3 million can be the nest egg for my entire retirement, but how or where would you invest this? After capital gains, I should get about 2.4 million. We currently have about 100,000 in student loans at 2.5%. We live comfortably, but the only extravagant spending is travel. We go on big vacations, usually for 4 or 5 weeks a year. That's pretty nice that you have that much vacation time. We owe about $350,000 left on our home at 2.6% interest. They were approved for a $2 million house, but decided to spend only $600,000, so they wouldn't be house poor. Okay, excellent. We have $225,000 in a 401k, $110,000 in a Roth IRA, and $50,000 in sounds like a taxable brokerage at Vanguard. I still max out my 401k. My wife puts in $6,000 per year toward the Roth IRAs, and they put $1,000 per month into 3 children's 529 plans. Okay. I want to put this windfall into something safe. I don't need 8 to 10% return, but probably best of all, I am not looking to retire anytime soon. I enjoy my job. I make good money off of my private practice, ASC Surgical Center, and the surgical hospital, and no longer take call by choice. Please let me know how you would proceed. Okay. This is a fun question. So first of all, I like to avoid the question itself first, but just kind of dig into the whole situation overall, because it doesn't matter how much money you make. What matters, or on the windfall, what really matters is if you know how to manage money at all. Because you put $1 million in the hands of somebody who can manage money well, that $1 million can do very well for you. Whereas you could give somebody $10 million who doesn't have a clue how to actually manage money, has never managed to build any wealth on their own, that 10 million could be gone in a few years, or like 1 year. Okay, so let's just kind of go through. I'm glad this person, first of all, this is an anonymous post. This is a very appropriate use of anonymous post. There are so many posts that are anonymous that I don't understand why they're anonymous. It's okay to ask questions in places where we ask questions and ask for help. But here, yeah, you made $3 million on an investment and you don't want the whole world to know who you are. Okay, sounds good. Like if I won the lottery, I probably wouldn't tell people I won the lottery. So first of all, let's go look at what the situation was before the $3 million windfall. Okay, so they have a house that's worth $600,000 and there's $250,000 on the mortgage, which means they paid down $350,000 of the house, or that's what it sounds like. I don't think that $600,000 is from appreciation. So let's just say they paid down $350,000 of it, $225,000 in a 401k, $110,000 in a Roth, $50,000 in taxable, and $100,000 in this startup venture. So that's a total of assets of $1,085,000. Okay. I wrote down the balance sheet, the assets and liabilities. Liabilities are $100,000 in student loans and a $250,000 mortgage. That's $350,000 in liabilities. So the net worth prior to this exit is $1,085,000 minus $350,000. That's a total of $735,000 of net worth. Now, this person's 39 years old. It doesn't sound like his wife works because it sounds like he makes a spousal contribution to the IRA. So he's making this money on his own. He's 39 years old. I don't know how many years he's worked, but he has $225,000 in a 401k in private practice. So if we assume he maxes out the 401k per year, then let's say he's been there for 4 or 5 years or so. Might not have been able to max it out the very first year due to delayed participation for new people, for example. So let's just say 5 years. Okay, so like finished training and fellowship maybe at age 34 and 39 right now. Okay. So I look at this and I don't know how much loans this person had before. There's $100,000 in student loans now, which is 5 years, let's say, later. So probably started out with, let's say, 250, maybe 300, which is pretty typical for people. So it sounds like they started out, let's say, at negative 200,000 and made it up to 735,000 of net worth over about 5 years. That's pretty solid. That's almost $1 million of increased net worth over a 5-year period or $200,000 per year. Okay, if there was 300,000 in student loans, then it would be 100,000 more than that. Okay. Yeah, somebody says, yeah, I wish. And it's interesting, you see these anonymous posts, and sometimes there's this person inside me that thinks maybe this isn't even real, because these posts always get like tons of comments. This is 160 comments after being posted only 4 hours ago. It's probably a real post, but posts like this tend to gather a lot of attention, and it definitely does get a lot of comments, which means then it boosts the group on the algorithm. Anyway, but let's say it's probably a real question. So, but first, I just want to assess how good of an investor the person is. And it sounds like the person is a pretty good investor. I don't know how much money this person has been earning throughout all of this. I can say comfortably the person is making more than $300,000 a year now, because based on the 401k balance, it sounds like most of that's going in there. I don't know why there's no cash balance pension plan in here, unless they have a bunch of employees. A group like this, I would assume, is a bunch of surgeons, and they own an ASC private practice. They should strongly consider getting a cash balance pension, because I would estimate that the average person in this group is making at least $600,000. And I think that's a relatively conservative estimate. It could be well north of that. They say the only extravagant spending is travel. I don't know how much that is, but they have relatively reasonable housing expenses. And they still managed to put in $3,000 into 529s, as well as maxing out the 401k, it sounds like, and the Roth IRAs, and then still putting more into the brokerage account. So in terms of how good they are at spending, I can't quite establish the savings rate, but I would expect it's a pretty good savings rate. They're probably putting in around $200,000 per year in total investments or paying down debt. So that's good. That's why I say probably at least $600,000, because if you pay tax on $600,000, I don't know what state this is, but that's probably about $200,000 in tax, maybe spending $200,000 and then investing $200,000. That's my estimate. So that's pretty good. Might have a savings rate around 50%. One of the key things when I look at this is they bought a $600,000 house, and they said they were approved for $2 million. So this person's income is a lot, but obviously was cognizant of where all the money was going, because he said he didn't want to be house poor. So this is really actually the biggest thing. When people have the option to spend way more money than they do, and then they don't do it, that means they have established this muscle of living within your means. That's like the most important thing of all things financial, is living well below your means. If you can do that, it doesn't matter how much money you make, because if you manage to do that, you will be fine over the long run. There's only one thing here that gives me a little bit of pause, And that is the fact that there was a $100,000 investment in a startup company at all that has already exited. This person's only 39. I don't know when this investment was made. I would say the investment was likely made probably at least 2 years ago for a startup to go from 100,000 to 3 million, maybe longer than that. $100,000 investment into one thing is a lot of money. I have a general rule about how much money to invest in any one asset. I think I've gotten a little bit more conservative over time. But, and first of all, I think you'd probably have to be or should be an accredited investor to actually put $100,000 into a startup. So this is probably, I would estimate, year 3 of being an attending, because as after 2 years of having income of $200,000 or more to do this, although maybe it did not require accredited investors. Okay. But $100,000, my opinion is you shouldn't invest more than ideally 2 months of your income into any one investment that you don't have control of, maybe 3 months at most, and or 10% of your net worth. And so if this was put in like 3 years out of training, and maybe the person made partner and is making $600,000 a year, that $100,000 is like 2 months. Okay, so maybe, but still also looking at net worth at that time, $100,000, probably the person's net worth at this time was around 400,000. So this maybe was only like, this was like maybe 25% of their net worth. It's a lot of money to put into one investment that is incredibly high risk. Okay, I don't know what other startups this person has invested. It doesn't sound like he has, because it's not listed here, but investing in a single startup is super risky. Okay, a lot of them go to zero. I do not recommend that anybody do this until you're worth well north of $2 million. Okay, unless you're able to do this with like $5,000, $10,000, like throwaway money. You should be worth like 2 million plus. You should be a qualified investor, in my opinion, because the risk is so unbelievably high and it's very illiquid. But as the person acknowledges, he got lucky, and you can absolutely get lucky and do very well. If you want to even go into like angel investing in that space, I personally would lean more toward like a fund where you have at least some diversification, where you have more likelihood of at least one of them being a home run. But this person got like crazy lucky because it sounds like this may be his only startup, super risky investment, and it just happened to be a home run at 30x. Okay. So first thing is, I think this person's pretty good with money in the first place. So this person's going to be fine. Okay. So that's been established. Now, do you have an investment policy statement? Okay. A lot of things can be answered with that. A lot of people asked, I remember before somebody had said, you know, if you made $1 million, what would you do with it? And to me, $1 million is just another $1 million. Like, yeah, just invest it the same way that you would invest any other $1 million. Just go ahead and follow the plan. But adding $3 million, that would definitely change my trajectory. And I don't just make $3 million in like a year. It would take years to accrue that kind of capital. That would change a lot. And so maybe investor policy statement does not, address issues like this. One of the most basic tenets of what to do with a windfall is just to literally sit on the money for a good period of time, at least 90 days to 180 days of literally doing nothing, because then you get past that like initial feeling of having all this money. And if you read Bogle has, they have like a whole page on what to do with when you manage a windfall, or how to manage a windfall. But assuming you don't have this addressed in your investment policy statement, okay, then I have some other general questions. First of all, when are you getting the money? Like, is the money in your pocket? First, they also say the payout is just north of $3 million, but after capital gains, I should get about 2.4 million. Okay, so I did some back calculations here, and first of all, and most people don't know this, but the top capital gains tax rate is 20%, but you have to pay net investment income tax, 3.8% on this. So it ends up really being 23.8%. I don't know if that was taken into consideration when calculating how much money the person would end up with. But if he did, then I estimate that the original amount of the capital gain would be $3.15 million. So this might be like $3.25 million minus the original $100,000 back. So then you end up with capital gains of 3.15, and that's taxed at 23.8%. And that ends up being $762,000 in tax and ending up with $2.4 million. So let's just back this train up. $762,000 in tax is more than you are worth today, assuming you haven't actually sold this. Well, okay, you can argue that you already are worth it if you haven't received the money. But before the valuation went up to $3.1 million or $3.2 million, $735,000 was your net worth. So this tax bill, just from this asset, is more than you are worth, your entire portfolio. Now you're earning, I think, north of $600,000 per year. And on $600,000 a year, you're paying income tax on that at, let me see on my graph, $600,000, married filing jointly, you're paying at $150,000 of federal income tax. So $150,000 in federal income tax plus $762,000 in capital gains, long-term capital gains. That's $900,000 in tax in 1 year. Okay. So first of all, I'm hoping for you that this money is not coming to you before December 31st. Okay? Because if it comes to you after December 31st, you will have a lot more time to deal with this gigantic tax problem, which is the best problem to have. The only reason I would be concerned about waiting, actually, this might be a big concern. I hate getting into politics, but if 2021, the new tax laws, if there are new tax laws that come into place, if long-term capital gains gets taxed like short-term capital gains, like ordinary income, then oh my gosh, that would be horrific, because then your $3.2 million will be taxed at 37%, plus the 3.8% net IIT, so NIIT, so that's 40.8% federal. That would be way worse than if it were taxed this year. But if you get it next year, then you at least have time to like deal with this, because it's late October and there's not a lot of time to deal with this gigantic tax bomb. It sounds like you've already resigned yourself to paying the tax. And I think that's the first problem with the question, because you don't have to resign yourself to paying all that tax. Okay. There are so many things that you could do to mitigate that. Also, what state do you live in? Because if you live in California, New York, New Jersey, and you haven't gotten the money yet, and it's not coming till next year, like, I know you love your job, but if you could take a year off your job and move to Texas or Florida, that could be a very valuable, you could take a whole year off to take a vacation, okay? Maybe move to Puerto Rico for the year. I don't know, but paying state tax on this could be a big problem too. I don't know what the capital gains tax rates though are in your state, wherever you live. But okay, that tax, $762,000 capital gains and your $150,000 in federal tax, that's brutal. That's $900,000. There are some things you can do to defer this. So yes, somebody asked, can you put it in an opportunity zone option? Absolutely. This is something you need to look at, because opportunity zones, this came out a couple years ago, and this is one of the amazing things you can do with very big capital gains. You could put money into something that isn't an opportunity zone investment. And I think there are even like funds for this, so you can do it diversified. I haven't honestly looked into it much because I don't have a bunch of capital gains to deal with. But yes, you could put money into an opportunity zone. And if that opportunity zone stays open, you keep the money in there for a certain number of years, a portion of it, of the tax liability, keeps decreasing. But if it stays for a total of 10 years, then it can potentially be just gone. Okay. Now, investing $3.2 million in an opportunity zone, that's a lot of money. And your total net worth right now is only 735, which is why, like, for people who don't necessarily invest in real estate, I think it's important to have some understanding of real estate and maybe at least invest a little bit passively in real estate so you learn about it. Because using real estate when you have a bunch of wealth is one of the best ways to manage and invest wealth once you have that capital, because it's super tax efficient. It gives you tons of cash flow as well as appreciation. I mean, it's one of the great ways to create a stream of income when you are, for example, retired. But you could do that now. If you were to invest it in an opportunity zone fund, or let's say a smattering of funds, like let's say there's $500,000 minimum in a fund and you do 6 different funds and each fund has, I don't know, 10 assets, then you could be diversified around 60 different assets. And you'd get diversification. Now, with opportunity zones, there's still, of course, risk, but oh my gosh, $762,000 in tax is a lot of money in tax just to disappear, right? That's like probably more than your net income for an entire year, which is why I'm saying, like, if you took a year off and you could avoid like tax, then maybe, like, if you move to Puerto Rico and this sale comes in next year. I mean, I don't know all the rules on that Puerto Rico rule, but that could be something to even consider because the savings could be worth less. Now, yes, so this person says, there are diversified opportunity zone funds. He does not need money now, not looking to go on vacay, person, loves job, blah, blah, blah. No federal, it's getting mixed. Oh, okay. No federal, at least taxes with opportunity zones. Yes. So exactly. Now you love your job and you're a partner, so you might not want to leave and lose that, but you never know. You could take a sabbatical. Like you could take a one-year sabbatical. It could be well worth it. Now, outside of an opportunity zone, we're just going to go back to, let's pretend the money were coming next year. Okay. If it comes this year, opportunity zone might be the only way to avoid these tax outside of getting capital losses somewhere else, but I don't know how much capital losses you could possibly have. So let's pretend the money's coming after the new year. Now you got a whole year to deal with this. Okay. And there is this carryback provision. So even if it were to happen this year, if you had a bunch of losses next year, you potentially could carry back losses. But let's pretend in 2021, you or your spouse could obtain full-time real estate professional status. Now, some people may have gotten the impression recently that I'm a naysayer to it. And I am absolutely not a naysayer to full-time real estate professional status. I just want to make sure that people are getting value out of getting full-time real estate professional status. And if they're going to cut 750 hours, or if they're going to cut down to 750 hours from maybe 2,000 hours, of their main job, and then putting 750 hours into doing real estate, like you're losing a lot of potential revenue. Okay. So there has to be a very compelling reason to do this. Now, this is a compelling reason to me because they're talking about $762,000 in tax. That again is likely more than your net income for 1 year, unless you're making like 1.1 million. $1.1 million would have about a $337,000 federal tax rate. So that'll be about 1.1 million. So if one of you could get full-time real estate professional status next year and acquire assets, you have $3 million here to utilize. You could buy a $10 million apartment complex with $3 million of capital all by yourself. You'd have a whole year to accomplish this. You could do multiple properties. You could do 3 properties at, let's say, $3 million each or so. It may be hard. getting big properties by yourself the first time around, even with the money, you may have to partner with another person who's already done deals to the size, so that sellers will pay attention to you, and so you can readily get good terms on a mortgage and get somebody to partner with you. And then that partner could also, help you with the asset management, because it's not something that and have experience doing. Okay, but my friends Lathy and Kenji, they have their fantastic course, Zero to Freedom, which teaches people how to manage, acquire assets and real estate directly. Like that course, unbelievable value in this situation. Okay. I have no affiliation with them, but they are awesome and their course is awesome. Because $762,000 in tax is just so much tax. Now, if it comes after January 1, you would have a whole year to deploy all that capital, and you or your spouse could obtain full-time real estate professional status. With all that capital deployed, you could then take bonus depreciation with cost segregation on this property, generate like $3 million of losses. Okay. And so you could basically wipe away your tax bill for the year. And so that $3 million of losses, it depends on how much you're able to get based on the asset you buy and what the cost segregation looks like. But if you're able to take $3 million of tax loss, then it could save you, easily that $762,000, because you'd wipe away the gain, but it would actually offset your ordinary income first, I believe, before offsetting capital gains, and the ordinary income is taxed overall higher. And you could just do this for 1 year. You just have to qualify for full-time real estate professional status just the 1 year. So you or your spouse puts in 750 hours, and that is more than you do in your other jobs. So unless you plan on cutting down, then you basically have to get your wife on board to put in 750 hours just 1 year, 15 hours a week, 1 year. Okay, so if you took the course and then, find asset, manage the asset, etc., then you take your net worth from this year. You're at 735 beforehand, and then you're going to add 2.4 million, so you'd be at 3.1. But instead, you're keeping all that tax, so then you're actually at $3.8 million. Okay, and now you own yourself like a $10 million apartment complex or something like that. Like, oh my gosh, that $10 million apartment complex is then going to throw off, like, let's just conservatively say you get 8% cash on cash on your investment of $3.2 million. $3.2 million times 8% is $240,000 a year plus $16,000. So around $256,000 a year. That's $20,000 a month, and that money would be like tax-free. It sounds like you're spending less than $20,000 a month as it is. And so you're financially independent today on this property if you manage this capital appropriately. Okay, now you like your job, and that's fine. You can like your job, but I don't know. Do you want to work at your job as much as you currently work? And I'm not saying that you need to put it in real estate. You could just invest it in the market, and yeah, sure, it would still potentially give you like a 3% withdrawal rate quite sustainably. If you were to take it out, that's like $90,000 or $8,000 a month. But it sounds like you probably spend well over $8,000 a month between all of your extravagant spending and travel, which I don't really know how extravagant that is. Like, we all have different opinions on what that is. But yeah, if I were in this situation, like with this, like, I don't want to say gun to my head, but if this was happening if this was happening after January 1, like I would go into like DEFCON 4 into, okay, how do I get full-time real estate professional status immediately? Either me or my wife, and I would just have to basically, if my wife didn't want to do it, I'd tell my job, I need to cut down to 2 days a week immediately, or I'm leaving, because I'm not throwing away $800,000 in tax this year that I don't have to spend, because that's a lot of tax. All right. So I think I covered everything. So first, you have to evaluate how good you are with money. And you sound like you're pretty good with money in the first place. What does your investment policy statement have to say? How to manage money? Don't know. It might not say anything about this, but know that there are options. If this is coming to you this year, you could consider putting it into an opportunity zone. If you don't want to do the full amount because you think there's, you're concerned about the risk, you could put a portion of it into opportunity zones and defer some of that tax. I mean, even if you are not really that into real estate at all, putting 10% into real estate or 20% is totally reasonable. I mean, even like White Coat Investor keeps, I think, he went up to around 20% into real estate. And if you're going to do that, I would start networking immediately with people who know about opportunity zone funds and consider getting cash invested stat. And net carryback losses can occur. So if you have money for next year to invest, you could go back and offset losses from this year. But the problem is if you do that, then you still have this $768,000 tax bond that's due on April 15th. So you would only have like $2.4 million to invest in real estate instead of like $3.2 million. And definitely want to invest 3.2 instead of 2.4 if you have the option to do that. All right, that's it for today. I'm not an accountant, not a financial advisor. I'm nothing certified with anything financial. I'm just here for my own entertainment, hopefully yours. Who else? Other chat messages. Maybe you could do a sabbatical to Bora Bora. You could set a trend. Get a partner. Here we go. This is it. Get a partner in real estate with at least 12 to 14 million of their own contribution and buy a big property. The depreciation will likely free up the windfall without taxes owned and with reps. Yeah. And, but you need to put the 750 hours in. So you need to have some material participation in something. So you should own at least some of your own assets, even if you don't put all 3 million of that into your own apartment. You could do it like a few single families and then a bunch of syndications. Okay. That's it for episode number 111. The active versus passive panel on the LGA forum today was awesome with Letty, Kenji, Elaine Steigerberg, Renee, Peter Kim, and one other. Somebody says, hey, can help the person with opportunity zone investment guidance if needed. Well, there you go. Somebody right here in the group. I'm going to post this on the forum where the question came from, and there you go. Have a great night, everybody. Until tomorrow, episode 112.